Lending and borrowing are key blocks in the foundation of finance. When we deposit funds into a bank, we are lending to them, and when we take out a loan, we are borrowing. Now, with that in mind, the lending and borrowing protocols, or money markets in DeFi, are the foundations that not only allow us to trustlessly participate in lending and borrowing, they're also the foundational building blocks in the DeFi financial stack. Now, when we are measuring the success of a given DeFi protocol, the most common metric is total value locked, or TVL, as we've mentioned previously. But we can also look at the market cap, which is the price per token multiplied by the number of tokens in circulation. These two metrics are decent in terms of giving a quick glance, but neither of them tell the whole picture. With TVL, it's important to know what kind of tokens are locked in the protocol and how those funds are used. Having $1 billion of ETH in a protocol is far less risky than having $1 billion of Doge locked in a protocol. And market caps are also highly flawed as a metric, because if a protocol has $1 billion market cap and the holders sell 10% of the tokens, the token price and the market cap will collapse far more than 10%. So we have these two flawed metrics here, and while each of them have their merits, we need to look a little bit further to get a better view of the full picture. Specifically, the metric I want to look at is loan to value, or LTV. This is where you compare the amount of collateral in a money market to the amount that is currently loaned out as a percent. This is important because if you want to deposit your funds and earn yield in one of these, the LTV is a key indicator to judge risk. If a protocol has higher LTV, this means more of their collateral is loaned out, and in a market crash or other emergency, there's a higher possibility that the collateral wouldn't be enough to cover the outstanding loans. At the very least, it can cause cascading liquidations for borrowers. That said, also the higher the LTV, there tends to be also higher earnings for lenders because there's more demand for them. Now, I've linked a page to Dune Analytics showing the LTV ratios of Aave, Compound, and MakerDAO, so you can check that out and we'll have a task related to it. Next, we'll cover some details about Aave and Compound individually, as we've already covered MakerDAO quite a bit in this course. Then I'll briefly cover some other decentralized protocols and then some centralized companies that are doing borrowing and lending as well. Now, looking at Aave and Compound, there are a lot of similarities in how they work. In either case, if you deposit funds in these protocols, your tokens go into a liquidity pool, or a smart contract, where other users can borrow them. In return, you receive other tokens as a receipt. In Aave, these are A tokens. In Compound, these are C tokens. The A and C tokens from these protocols are what you use to redeem your original deposit. But how these A and C tokens work is very different from each other. In Aave, the A tokens are equal in value to the tokens they represent. So if you deposit 1 ETH, you receive 1 A ETH. And then you can return back the A ETH and get your ETH back. A tokens are interest bearing, so when you're holding an A ETH, you'll receive interest payments from the people borrowing your ETH. These payments will go straight into the wallet holding the A ETH, or you can designate a different wallet to receive them. You can literally watch your wallet balance grow in real time from these interest payments because of the magic of DeFi. Now, in Compound, things are different. Let's say you deposit the DAI stablecoin. You'll receive an equal dollar value worth of CDAI, which, like A tokens, is an ERC20 token that is tradable. The price of CDAI isn't pegged one-to-one to the price of DAI, though. When a new market on Compound is created, and this is the same for all of them, the exchange rate between a token like DAI and CDAI starts at 0.02, and then it slowly increases in price compared to DAI. The amount the C tokens increase is determined by the interest rates borrowers are willing to pay for DAI. So the longer you hold CDAI, the more valuable it becomes and the more DAI you can get back when you pull out your deposit. So if the APY for lending DAI is 4%, the price of CDAI compared to DAI will increase by 4% annually. In theory, anyway. In the real world, there's still volatility between DAI and CDAI because they're both publicly tradable and therefore, subject to price fluctuations from supply and demand. But looking at the CDAI price chart over the past year, we can see that it does steadily increase in value, and the price of CDAI is 4.6% higher than it was a year ago. However, this is a CDAI USD chart and not a CDAI DAI chart. Now, as we're going to learn in the stablecoin deep dive, DAI itself has volatility, so the volatility here isn't surprising. So let's compare something that gives a more accurate picture of C token value. Looking at the CETH to ETH chart, we can see it is very marginally above the 0.02 ETH it started at. And why is that the case? Looking at the markets on compound.finance, we can see that the APY for depositing ETH is a measly 0.1%. Again, these interest rates are market driven, so if there's not a lot of demand for borrowing ETH, the APY will be very low. And that makes sense because it's very risky to borrow ETH. If I borrowed 1 ETH at the beginning of August, I'd be borrowing about $2,500. A month later, that 1 ETH is worth almost $4,000. So paying it back would be much more expensive, provided I didn't get liquidated during the process from having a collateralization ratio too low. Now, we'll dig more into Aave in our tutorial in the next lesson, and there will be links below for you to check out Compound as well. For now, there are a couple other protocols that I want to mention. The first of the smaller money markets I want to mention is Alchemix. Now, Alchemix is really interesting because when you deposit collateral and take out a loan, your collateral is put to work yield farming, earning interest, and over time, your loan will be automatically paid off. Wouldn't that be nice if all of our loans could do that? Here's how it works. You deposit DAI to mint ALUSD, their stablecoiner. Once you have your ALUSD, you're free to trade it or use it as you would any other token. You can mint up to 50% of your collateral amount. That means your loans are 200% collateralized. This is really high for a stablecoin. For example, on Aave, you can borrow up to 75% of your DAI deposit. So that's 50% more DAI from the same amount of collateral as on Alchemix. But in Aave, your loan does not pay itself off. In Alchemix, when you deposit DAI, that DAI is moved to the YDAI vault on Yearn Finance. The yield earned on Yearn goes to pay down all DAI tokens in Alchemix. So if you just deposited DAI in Alchemix and you didn't take out a loan, you'd just be earning yield from that Yearn vault. Then ALUSD is always redeemable 1-to-1 for DAI in Alchemix. So if the ALUSD stablecoin broke below the peg, borrowers can buy ALUSD on an exchange and pay off their loans at a discount. That said, ALUSD is backed by DAI and the future yields of it. And having a stablecoin backed by future yield is definitely a lot riskier than having an over-collateralized stablecoin like DAI. All in all, Alchemix is a really interesting and it's a novel system, and I personally really like the whole alchemy and transmutation branding they have. Just practice risk management if you want to use it as always. Now the next one I want to mention is TrueFi. TrueFi is a hybrid DeFi CeFi protocol from the creators of Trust Token and TrueUSD. It allows for completely uncollateralized loans, not under-collateralized, 0% collateralization, which sounds like it wouldn't work at first glance, and in reality, it wouldn't work if it was a full-on DeFi protocol, at least not with our current DeFi identity systems that we have. It's the CeFi aspect that allows it because these loans are only available to vetted and KYC'd institutions. That way, there are legal ramifications if they fail to pay back their loans. Then the DeFi aspect is for the lenders. Anyone can deposit funds into these liquidity pools, and since the borrowers don't have to put a bunch of collateral up in order to take out a loan, they're generally willing to pay higher interest rates, so lenders can earn more here than they could at competing protocols, in theory anyway. Now, I don't want to go into too much detail here, but I definitely think it's worth mentioning. I did do an explainer video on TrueFi on my channel, and I interviewed their CEO, so if you're interested, those will be linked below. Now let's look at the centralized money markets, or crypto banks as they are commonly known. I only want to briefly mention these because they play a big role in the crypto space, but I want to be clear that all of these are centralized companies. Essentially, they are banks, but with better yields and user experiences, but they're also not FDIC insured like other banks in the US are at least. The big three are Celsius, BlockFi, and Nexo. These are custodial accounts where you go through KYC, you deposit your crypto, and you earn interest on it. Very similar to a traditional bank account, only they accept crypto. The onboarding process for people new to crypto is much easier with these centralized institutions because users don't have to self-custody, but there are big risks that come along with it. First, you don't own your crypto if you don't have custody of it, and I can't stress that enough. Second, This eventually leads to fractional reserve banking all over again, which is a major part of what sparked the creation of Bitcoin in the first place. Third, you don't know what they're doing with your data, and if you do decide to use any of these services, I highly recommend you thoroughly read and understand their privacy policies, because all three of them use your personal information for marketing purposes, and all three of them have stipulations that they may disclose your data to third parties for various reasons. Same goes for centralized exchanges. They do the same thing. Now, on top of that, BlockFi had a data breach in May of 2020 because one of their employees was hit with a SIM swap attack. It's too bad my security video wasn't made back then telling them to use hardware-based two-factor authentication and not SMS-based two-factor authentication, because the data breach led to the leak of their clients' personal information, including their names, email addresses, birth dates, physical addresses, and activity history. Now that is a major problem because those users are physically at risk of extortion or worse. Seriously, get your own privacy and security in order if you haven't done this yet. Do it before moving on to this course. It's so important. If those users were using Proton Mail with different aliases for different accounts, their primary email addresses would still be secure. If they're using Virtual Mailbox for their physical addresses, their physical safety and that of their families wouldn't be at risk. This is very similar to the data breach that happened to Ledger, so this could happen to any site that holds your personal information, and it's important to remember that. With all that said, I know this kind of thing is rare and it's unlikely to happen to anyone watching this video, but you've got to decide for yourself what kind of trade-offs you want between convenience and security. Now, with that tangent aside, and in the interest of sharing the whole picture, I do want to mention that these centralized crypto banks generally offer higher interest rates than those in blue chip DeFi money markets that I've mentioned. But you could earn more right now by farming on Yearn Finance, among other yield farms as well. So there's different options for different things. Time will tell if these crypto banks are able to stay competitive, considering how much more capital efficient DeFi is. I expect in the very long term, we'll see crypto banks come and go. Some will be around for a long time, but in the long term, the major DeFi protocols that work out governance and maintain decentralization will be around for the foreseeable future, possibly even centuries. That's the benefit of an anti-fragile decentralized system. They're very hard to kill. Now, before I wrap up this lesson, I also want to mention that Celsius has their own token, and that enables them to offer better yields than BlockFi or Nexo, up to 17% interest if you accept payment in Cell tokens. This is similar to Yield App, which is another crypto bank that offers it. On Yield App, you can also get 17% interest on stablecoins, but it's 11% rewards in stables and the rest paid in yield tokens, depending on how many yield you hold. Now, I also did an explainer on yield and interviewed the CEO, so those will be linked as well. All in all, regarding crypto banks, they do offer high yields and easier onboarding, but they come with their own set of risks as well. I didn't even mention regulatory risk, and several crypto banks, including Celsius and BlockFi, have found themselves in the SEC crosshairs. Hard to say how it will play out, but that's important to understand the whole picture as well as you can. So, your tasks for this lesson are to take a look at the LTVs of Aave, Compound, and MakerDAO, and talk about the differences. Why does MakerDAO have a much higher LTV than the other two? What incentives are at play that encourages users to deposit more funds into Aave and Compound that are not in play at MakerDAO? So specifically answer that question. Once you've made a post and or commented on at least 2 other posts in the forum, check out the Publish 0x article that I linked that lists different DeFi trackers and analytics platforms. Take a look at the different sites on the list and use them as a resource when you want to look into this for your own purposes. Then in the next lesson, we're going to have a tutorial on using Aave to lend and borrow funds. I'll see you there.